In this video, I'm going to explain to you exactly what the stock market is, what you need to start investing, and other important things that you need to know as a stock market beginner. More specifically, I'm going to cover topics such as what stocks are and how you can invest in them, ways you can make money on your stock investments, how often you should buy stocks based on advice from famed investor Warren Buffett. I'm also going to talk about investing in stocks versus ETFs, and also share with you what ETFs are and compare the pros and cons to simply investing in stocks by themselves. Stick with me because you're about to learn some helpful and important things that will leave you feeling much more confident when it comes to investing in the stock market. Let's get started. First and foremost, what are stocks? A share of stock represents ownership in a particular company. Individual investors like you and I can invest in a company's shares of stock, and therefore we will own a very small portion of that company depending on how many shares we purchase. But regardless, if you buy a company's shares, you own a portion of that company, and your intention when buying shares of stock is to see that company's valuation increase over time, and therefore you will have an appreciation on your shares, and therefore your investment will appreciate in value. When a company is initially created, it is said to be privately held, which means the entirety of the company is owned by the owners, and the shares of stock are not listed on a public exchange, and therefore not available to you and I to purchase and therefore invest in that particular company. The process of taking a privately held company and issuing shares of stock to the public is called the initial public offering, or IPO. A privately held company that decides to issue shares to the public is a company that is said to be going public. After a company has its IPO, individual investors like you and I can purchase shares of that company's stock, and therefore we will participate in the future growth potential of that company's valuation. Or, as I mentioned earlier, if the company's value does not increase and business is not going well, the share price will decrease along with the value of that company, and unfortunately, as a stock investor, we will lose money on that position. It's important to remember that when you buy shares of a company's stock, you are investing in that company as you are a very small owner in the stake of that company. And therefore, when you buy a company's shares of stock, you want that company's valuation to increase in the future, as that will lead to increases in the company's stock price. But how do you gauge a company's actual valuation? Well, a company's valuation is called the market capitalization, or market cap for short. A company's market capitalization, or market valuation, is equal to the company's stock price multiplied by the number of shares outstanding, which is simply the number of shares that are currently in circulation in the public market. For example, let's look at Amazon's market capitalization, and if you aren't familiar with Amazon, Amazon's ticker symbol is AMZN. In this image, we can see that Amazon's stock price closed at $1,822.99. As of this image, Amazon had 494.66 million shares outstanding, and if we multiply that stock price by the number of shares outstanding, we get a market capitalization of just over $900 billion. That's with a B. For whatever reason, the market capitalization listed on this page is short by about $20 billion, but $20 billion is just a rounding error in the context of a $900 billion company. If you want to know the value of getting people anything they want with free delivery in 1 to 2 days, it's $900 billion. Let's talk about what you actually need to go about purchasing shares of stock in your own investment accounts. The only thing that you need is a brokerage firm that you've opened in your name. There are dozens of different brokerage firms to choose from. I personally use Tastyworks, which is a brokerage firm that's focused more so on options trading because their options trading commission structure is insanely favorable for me. But since I do a lot of options trading, I trade with Tastyworks. But if you're just investing in shares of stock, you don't necessarily need a full-fledged trading platform like you'd get if you signed up with a brokerage firm such as Tastyworks. As of this recording, it's not released yet, but Doe is a free investing app that will have free stock trading, so you'll be able to purchase shares of stock with no commissions. And more importantly, Doe will have tons of amazing content on the app, including videos that explain what's going on in different industries and with different companies, so you can get more educated in the context of the stock market and with particular companies that you may be interested in. There's a link down in the description where you can learn more about the Doe investing app and what they're all about, and also see what some of the content's going to look like once that app is fully released. Let's move on and talk about the ways that you can make money when investing in shares of stock. The first and most straightforward approach that you're going to make money when investing in a company's stock is through share price appreciation. And share price appreciation just means that the stock price is increasing from the price that you initially paid for that company. For instance, if I buy a share of stock for $100 per share and a year later that company's stock price is at $115, I will have an unrealized gain of $15 per share, which is a 15% return on my initial $100 investment, since the stock price is now 15% or $15 higher than my initial purchase price. Unfortunately, things don't always work out so well, and if I buy a stock and the stock price goes down, unfortunately, I'm going to lose money on that investment. For example, if I buy 100 shares of stock for $105 per share and the stock price later falls to $75, I will have a $30 loss per share, and since I own 100 shares of stock, that $30 loss per share means that my investment position is down a total of $3,000, because a $30 loss per share times 100 shares gives me an unrealized loss of $3,000. The great thing about investing in the stock market is that there's a very low probability that you're going to lose 100% of what you invested, as for that to happen, that company that you invested in would have to go to $0 per share, which effectively means that company went out of business and is no longer operating. I'm not guaranteeing that you're not going to lose money when investing in the stock market, but all I'm saying is that if you choose quality companies and invest in those companies for the long term, the likelihood that you're going to lose money on your investment is very low. At this point, you might naturally be wondering, what makes a stock's price increase or decrease? In the simplest terms possible, a company's stock price is a reflection of the market's perception of that company's potential earnings growth into the future. A company's share price will increase when there's a lot of demand or a lot of people willing to purchase that stock, but there's not a lot of supply or a lot of people willing to sell their shares of stock at whatever the current market price is. So if there's not a lot of supply or people willing to sell at the current share price, that means there's not a lot of people that are going to be able to purchase shares of stock at the current share price, and therefore the sellers are going to demand a higher price to sell the shares, which means the buyers are going to have to pay more for the shares of stock. But also it could work out that the buyers are so interested in purchasing shares of stock that they're willing to pay a higher price for the shares of stock, which means the sellers will receive more for the shares of stock, and as a result of that supply and demand equation, the stock's price will increase. Higher offering prices from buyers and higher asking prices from sellers results in a higher stock price overall. With that being said, what causes an increase in demand for a company's stock? As mentioned earlier, a company's stock price is a reflection of the market's perception of that company's earnings potential into the future. Therefore, the demand for a company's shares will increase when the market perceives that company's earnings potential to have increased. As an example, let's take a look at what happened to Apple's stock price when Steve Jobs initially announced the iPhone on January 9th, 2007. As we can see, the announcement of the iPhone led to an increase in Apple's stock price. Investors were eager to buy shares of Apple stock as they perceived the iPhone to be a great thing for the future of Apple's profitability. Those who bought into Apple stock on that day and held on for the long term did phenomenally, but of course it doesn't always work out that way. Just like the demand can increase for a company's shares of stock, demand can also decrease for a company's shares of stock if the market perceives that company's growth potential to have stalled, or they see the company's growth potential actually going negative into the future, meaning that company's valuation will decrease going forward due to faulty business operations or whatever the case may be. If the market perceives a company's future growth potential to have stalled, or they believe that company will actually lose value in the future, investors in that company's stock will move quickly to sell their shares. And because there's a lot of supply, meaning that there's a lot of people trying to get out of their stock position and sell it at the current market price, and there's not a lot of demand or people wanting to buy shares of that company's stock, demand is low and supply is high, and because of that supply and demand imbalance, the company's share price will decrease because buyers will only purchase the shares of stock at lower prices than the current market value, and because there's so much supply, people are willing to get out of their shares at whatever price people are willing to buy the shares for, which leads to a decrease in the company's share price. A company's perceived long-term earnings potential is the number one influence in the changes of that company's stock price. Moving on to the second way you can make money when investing in shares of stock is through a company's dividend payments. So some companies pay dividends, which is a redistribution of their profits, in which case if you own shares of that company's stock and that company does pay a dividend, for every share that you own, you're going to be collecting money based on the amount of the dividend that that company pays out. Typically, companies will pay out stock dividends on a quarterly basis, which means you'll receive dividend payments 4 times a year on each share that you own in those particular companies that pay out dividends. But not all stocks pay dividends, as dividend-paying stocks are typically larger, more established companies that are out of their initial growth phase. Non-dividend-paying companies are still typically in their growth phase, and they're using all of the profits in the business to reinvest into the business and hopefully grow the company even more. So just because a company does not pay a dividend, it doesn't mean it's a bad thing. It typically just means that that company is still in its growth phase and is using all of the profits in the business to reinvest back into the business, as opposed to paying out a portion of the profits in the form of a dividend to existing shareholders. An example of a dividend-paying company is Coca-Cola, which has the ticker symbol KO. Coca-Cola is obviously a well-established company that has been around for a long period of time, and instead of taking all the profits from their business and investing it back into the business, they reward their shareholders by paying out a quarterly dividend. As of this recording, Coca-Cola is paying out a $1.60 annual dividend per share, but since they pay it out quarterly, that means they're paying out a 40-cent dividend to existing shareholders on a quarterly basis. If you own 100 shares of Coca-Cola and they pay out a $1.60 per share dividend on an annual basis, that means on your 100 share position in Coca-Cola, on a yearly basis, you will earn $160 in dividends since you own 100 shares, and you'll collect $1.60 per share in the form of a dividend on a yearly basis. Next, I'm going to talk about how often you should buy stocks based on advice from famed investor Warren Buffett. As you begin to earn more money and be able to save more money that you can invest in shares of stock, it's commonly accepted that buying shares of stock as frequently as possible is a great long-term strategy, especially if you can purchase shares of stock on a monthly or even weekly basis. Warren Buffett himself has often said that people should buy stocks as often as they can and ignore the short-term price fluctuations in those stocks. In a Squawk Box interview, Warren Buffett said, if they think they can dance in and out of the market and buy and sell stocks, they ought to head for Vegas. But what they can do is determine that there's a number of solid American businesses, a great number of them, and if you own a cross-section of them, and particularly if you buy them over time, you basically can't lose. The strategy of buying stocks periodically over time is especially beneficial during bear market periods when stock prices have fallen. While emotionally and psychologically it's very scary to purchase a stock when its price is falling, keep in mind that during a bear market period, you're able to purchase more shares of that company's stock because the stock's price is lower. The stock investors who did the worst through the 2008 financial crisis are those who sold their shares of stock in the bear market period and did not want to lose any more money. People who actually held on to their investments and purchased more shares of stock throughout that market decline, those people did extremely well ever since then, as the market is up considerably since 2008. Which brings me to my next subject, which is trying to time the market. Should you try and time the market when purchasing shares of stock, or should you periodically invest your money into shares of stock and ignore the short-term price fluctuations that are inevitable? Famed mutual fund manager and investor Peter Lynch has a famous quote about timing the market. Peter once said that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Warren Buffett also agrees that trying to time the market is a losing game. In a Squawk Box interview, Warren Buffett said, "I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now." So we've talked a lot about investing in the stock market at this point, but I want to talk about investing in stocks versus investing in ETFs, or exchange traded funds. When you invest in stocks, you're purchasing shares of an individual company such as Coca-Cola, Netflix, or American Express. But as a stock market investor, you are not limited to investing in individual companies. You can also invest in what are called ETFs, or exchange traded funds. An exchange traded fund, or ETF, is simply a mutual fund that has shares listed on a public stock exchange, which means you can buy shares of that fund through the public market without going through an investment company and buying their mutual funds. If you're unfamiliar with mutual funds, a mutual fund is a professionally managed and diversified portfolio of holdings. Unfortunately, most of the time, mutual funds will have really high management fees, which means every single year you're going to lose a portion of your investments to the management fees. But more importantly, a lot of mutual funds underperform the broad stock market as measured by something like the S&P 500 index. The benefit of ETFs over mutual funds is that ETFs typically have much lower fees compared to mutual funds, so your investments will continue to grow and compound faster than they would when investing in a mutual fund, because when you're invested in a high fee mutual fund, you're going to pay a lot more in fees, which means the amount that you're paying in fees that you could have saved by simply investing in an ETF will not grow and compound over time. One of the most popular ETFs, if not the most popular ETF itself, is the S&P 500 Stock Market Index ETF. That has the ticker symbol SPY, but you may hear people refer to it as SPY. When you buy a share of SPY, you're investing in the 500 companies that make up the S&P 500 Stock Market Index. As of this recording, one share of SPY is trading at $300. That means for $300, you're purchasing 500 companies and therefore getting a very diversified investment. And that investment will have virtually no fees, since as of this recording, the annual expense ratio or management fee for investing in SPY is 0.09% of your holdings. So in other words, if you had $10,000 invested in SPY, you would pay $9 in management fees for the year that you invested in SPY with $10,000. Instead, if you invested $10,000 in a mutual fund that was charging a 1% annual management fee, at the end of 1 year, you would essentially pay $100 in fees for having a $10,000 investment in that mutual fund, since a 1% fee on $10,000 is $100. Another benefit of investing in ETFs is that if the ETF has holdings that pay out dividends, the ETFs will pay out a dividend which is equal to the appropriate amount that you are owed for owning one share of that ETF. Keep in mind that while most ETFs are a diversified portfolio of holdings, some ETFs actually track single commodities such as gold, in which case if you invest in a gold ETF, you are not getting exposure to a diversified portfolio of holdings, but you are getting exposure to gold through an ETF, which is going to be much cheaper than actually buying physical gold. Here are some popular ETFs and what they track. As we've already discussed, SPY is the S&P 500 ETF, which is the large cap stock market index. Other ETFs include IWM, which is the Russell 2000 ETF, which tracks small caps. QQQ is the NASDAQ 100 ETF, which is a tech-heavy index that does not include financials. XLF is a financial sector ETF, meaning that the ETF invests only in financial companies. EEM is the emerging markets ETF, and as I've just mentioned, GLD is the gold ETF, which tracks gold. As an example of how much fees matter when considering investments, if I had a $10,000 investment that achieved 8% per year for 30 years, let's look at the difference between paying 0.09% and 1% a year in annual management fees. With an annual investment fee of 0.09% on a $10,000 starting balance, my investment over a 30-year period, when it achieves an 8% return per year, would grow to about $98,000 over a 30-year period. However, if I invested $10,000 in a fund that also got 8% per year for 30 years, but I was instead paying 1% per year in management fees, my initial $10,000 investment would grow to about $75,000 over a 30-year period, which is nearly 25% less than the same investment achieving the same return but paying 0.09% a year in fees as opposed to 1% per year in fees. If there's one thing you take away from this video, it's that you can invest your money on your own just as well as a mutual fund manager would by simply investing in a broad stock market ETF such as SPY or IWM, and by doing so, you will achieve the annual rates of returns of those stock market indices, but you will also, and more importantly, pay way less in fees compared to if you gave your money to a mutual fund manager who's doing the same thing for you, except they're charging a lot more in fees. In the last sections of this video, we're going to talk about more specific concepts and events related to investing in the stock market. Up next, we're going to talk about stock splits. When invested in a company's shares of stock, sometimes a company will issue a stock split, which is typically going to occur if the stock price is high and the company wants to reduce the share price to make it more accessible to more investors. As a real example, Apple underwent a 7-for-1 stock split a number of years ago when their stock price was around $700. If I owned 100 shares of Apple stock when the stock price was at $700, that would represent a $70,000 position. After the 7-for-1 stock split, my $700 stock would go to a $100 stock since Apple is reducing the price of the shares through a stock split. But since the stock price goes from $700 to $100, the number of shares that I own would go from 100 to 700. So if I own 100 shares of a $700 stock pre-split, that's a $70,000 position. But if the stock does a 7-for-1 stock split and I therefore own 700 shares of a $100 stock, that is also a $70,000 position. So I just wanted to bring this up because if you do invest in a company and it undergoes a stock split, you don't have to worry about anything. There's nothing that's going to happen to your investment value. The only things that you'll notice is that you'll have a different number of shares and the share price will be different, but the overall value of your investment position will remain the same before and after the stock split. The next subject I want to talk about, which is everybody's favorite subject, is taxes. Knowing that you would have turned this video off immediately if I started the video by talking about taxes on stock profits, I decided to save this subject to the end, but it is an important subject nonetheless, so let's get started. When it comes to taxes on stock market investments, there are a few things that you need to know. Taxes on stock market investments fall into the category of capital gains taxes, which is essentially any tax on something that you've purchased and sold and made a profit on. If you buy a stock for $100 and later sell that stock for $110, you have a capital gain of $10 per share, which is subject to taxes. Capital gains taxes are divided into two categories: short-term capital gains taxes and long-term capital gains taxes. Short-term capital gains are the profits that you make from buying and selling something in less than 1 year. So in other words, you buy something and sell it at a profit and your holding period was less than 1 year. That would be a short-term capital gain. Long-term capital gains are profits on anything that you've purchased and sold while holding it for more than 1 year. So if you buy a share of stock and you hold it for more than 1 year and sell that share of stock for a profit, that would be considered a long-term capital gain. Short-term capital gains are taxed at your ordinary income tax rate, while long-term capital gains are taxed at different rates depending on your income and filing status. Based on 2019 taxes, someone who is making $100,000 per year is in the 24% tax bracket, which means any short-term capital gains that they make would be taxed at a rate of 24%. However, that same exact investor would only pay a 15% tax rate on any long-term capital gains, therefore paying much less in taxes if they have a holding period of more than 1 year, and therefore being subject to long-term capital gains taxes. Based on these figures, it's clear that it's very advantageous to hold stock positions for longer than 1 year, especially if you're in a higher income tax bracket. To wrap up this video, I'm going to quickly talk about selecting stocks to buy, shorting stocks, and an advanced topic called options. When it comes to choosing companies to invest in, there are two general approaches. The first approach is called fundamental analysis, which consists of analyzing a company's business and financials to determine whether or not you want to make an investment in that company's stock. Fundamental analysis is essentially the approach that Warren Buffett uses before making a decision to invest in a company. The second general approach that is used by investors to determine when to purchase a company's stock is called technical analysis. And technical analysis generally is looking at a stock's price patterns and determining when that stock should be purchased and when it should be sold. Technical analysis is more short-term in nature, while fundamental analysis is much more a long-term game, as you're analyzing a company's business and potential earnings in the future, and therefore making your investment decision based on the actual business as opposed to historical changes in that company's stock price. You'll have to decide which approach you believe in more. Personally, I think fundamental analysis is a much more sustainable and long-term approach to selecting companies to invest in, because technical analysis does not concern itself with the actual health of the company. It just concerns itself with the historical price patterns of that company's stock price. The next topic that I'm going to touch on very quickly is called shorting shares of stock. Typically, when investing in the stock market, you have a buy low, sell high mentality, meaning that you're buying shares of stock with the intention of selling them at a higher price in the future. However, you can actually take the opposite side of that and take on a sell high, buy low mentality, and the way you do that is through shorting stocks. Shorting stocks is the act of borrowing or selling shares of stock that you do not yet own, and therefore your intention is to buy them back or cover them at a lower price at some time in the future. By shorting shares of stock, you're saying that you're going to sell the stock price now and your intention is to buy it back at a lower price in the future, which means you're betting against the success of that company. Shorting stocks is a highly risky strategy as there's theoretically no limit to how much a stock's price can increase, and therefore when you short a company's stock, you theoretically have unlimited loss potential because, as I said, there's no limit to how much a stock's price can increase. For the sake of completeness, I wanted to mention shorting shares of stock, but I personally do not recommend shorting shares of stock as that is not a long-term investment strategy. The purpose of this video is to help you learn more about investing in the stock market, and as far as I'm concerned, shorting shares of stock is more of a trading strategy as opposed to a long-term investment strategy. The last advanced topic that I want to touch on is options, and options are a complex financial instrument typically used by traders to make short-term leveraged bets on stock price direction. What I mean by that is they can use options to make leverage returns from small changes in a stock's price, but options can also be used in a more intelligent and conservative manner as they can be used to enhance the return potential on a stock position that you own, and they can also be used to reduce the loss potential on stock positions that you're invested in. I've spent the last 6 years studying and teaching options trading, but I trade options in a very systematic and disciplined manner. I don't trade options in the home run trading or gambling type of way, which is unfortunately how most people treat options when they get into it. I'm not going to talk about options here as it's outside the scope of this video, but I have built an entire YouTube channel where I teach options trading, the various strategies, and everything that you need to know if you're interested in learning about options trading. So go ahead and check out the link in the description if you want to check out my options trading channel, which is called Project Option. If you enjoyed this video and found it helpful, please leave a comment down below and let me know what you liked, and be sure to hit that subscribe button so you can get all of my videos in the future. I've also left a lot of links in the description for additional resources that you can use to continue learning about investing in the stock market. My name is Chris Butler, and I will see you in the next video.